Hello and welcome to the third video installment here at the Expat Teacher Network. As always, we'd like to begin by stating two things. First, that this video is part of a series, and it really is best if you watch the series in order. As with our second video, in the third video we'll be talking about things that we've talked about in previous videos. And so if you haven't seen those videos, it makes things, well, frankly, a little confusing. Second thing we'd like to remind our viewers of is that none of us here at the Expat Teacher Network are CFAs, Certified Financial Advisors. We are simply passing on information that we have learned from a variety of sources, and we're hoping it's of help and benefit to our members and viewers. But individual financial decisions should be made in conjunction with either your own financial advisors or based on your own research and experience. Okay, having said that, we're going to get started today. As you can hopefully see there at the bottom, what we're talking about today is index funds versus managed funds. We're going to start very, very basically. We're going to start by talking about what is a mutual fund and what is an index. We're going to define some of these terms. We're going to go on the assumption that not all of you know what all of these terms mean. And basically, there's two main things that we're going to talk about today, which we'll mention in our conclusion. One is that small percentages pack a big punch. We're going to be talking a lot about commissions and fees and things, and how these fees and commissions essentially hinder your ability to make and grow money. And we're also going to show you, hopefully, that not all mutual funds are the same. Okay, so let's get started here. The first thing is, what is a mutual fund anyway? Well, essentially, it's group buying of stocks and securities. Instead of buying 100 shares of BMW or General Electric or Microsoft, you go out and buy shares of a mutual fund, which is essentially investors pooling their money and giving it to a fund manager who in turn will invest it in the securities and stocks that they think are most likely to go up in the near future. A lot of these fund managers, they don't work for free, and most of them that deal with the really big funds, the pension funds and the hedge funds, are incredibly experienced and make a heck of a lot of money, and they will buy and sell, frankly, quite a bit in a 12-month period. The other thing to say is that these mutual funds usually include a small percentage of things like bonds, precious metals, foreign currencies. And the whole concept behind a mutual fund is that you don't have to put all of your eggs in one basket, that instead of buying 100 shares of one company and then you're dependent upon whether that particular company does well or not, you go out and pool your money with a whole bunch of other investors, and you give it to somebody who, instead of buying 100 shares of one company, buys 100 shares of 100 companies. And this diversification means safety. In other words, you're no longer dependent upon whether one stock does well. You're now looking at, what do 100 stocks do? And hopefully with this little diagram that you see here at the bottom, it explains it better than I just have. But essentially, it's kind of like group life insurance, where there's a security in numbers. It's pooling of money and sharing of risk, and that risk means safety for your money. Okay, so then in our title, we're calling our title today Index Funds versus Managed Funds. So what is an index? Well, the best analogy I've heard so far comes from our colleague Andrew Hallam, who wrote the book Millionaire Teacher, a book, by the way, that we recommend highly to all of our members. In fact, it forms the basis of a lot of what we're talking about today. Andrew's second book, also his book on expat investing, regardless of where you live in the world, is also a book that we've used heavily in order to inform ourselves for videos such as this. Both books are available on Amazon. If you go to our website, expatteachernetwork.com, we have direct links to them. Simply click on the picture of the book. It'll take you right to the Amazon page. There's a Kindle version of the books, which is substantially less expensive. I've bought both print and Kindle. I must admit, I bought Kindle to see if I wanted it. I do that a lot. And then I bought the print versions as well so that I can mark it up. Anyway, back to our topic here. What is an index? Well, what Andrew talks about in his book Millionaire Teacher is he said, think of an index fund like the index at the back of a nonfiction book. It's the list of all items that are discussed in that book. And stock indexes are basically the same thing, or an index fund. It's a list of all of the stocks on that stock market. And sometimes it's just the main ones, because sometimes they want to pick out, they being the experts or some sort of analytical or regulatory body wants to pick out the main stocks from a particular stock market because they believe that the performance of these stocks will best demonstrate how the overall stock market in that country is doing. So the example of an index where I live is the DAX 30. I live in Germany, and the DAX 30 is just what it says. It's the 30 biggest companies in Germany on a list, and they will track those 30 companies. Does it mean that all of those 30 companies make a gain in a day when, for example, the DAX goes up by 70 or 80? A few days ago, it went up by over 100 points. Does it mean that every single one of those 30 stocks goes up? No. Some go up, some go down, and then they average it out. Right. Another example, if you live in Great Britain, is the FTSE 100. Of course, the S&P, the Standard & Poor's 500, if you live in the United States. And sometimes the companies that are listed on these indexes will change over time. For example, on the Dow Jones Industrial Average, one of the biggest indexes in the United States, one of the main companies is Microsoft. Well, was Microsoft on the Dow Jones in 1975? No, it definitely was not. It may not even have been there in 1985. I'm not even sure when it was put on there. So if we take that information and place it into what we already know about mutual funds, an index fund is a mutual fund that invests in all of the stocks of that particular market. So for example, if you have a US stock market index fund, basically that stock index fund will buy shares of all of the stocks on the New York Stock Exchange, all of them, or as many of them as they possibly can. Okay? And the theory behind that is if we buy the entire market, then the fund will perform exactly the same as the market does. So, having said that, let's move on. We'll just sort of let that simmer for a little bit. In order to give us basic diversification, this is something Andrew talks about in his book, and it's really, really very clever. He basically says that, look, in order to achieve diversification and therefore safety, you really only need three things. You need a home country stock market index fund. So if you live in the United States, you need an index fund that tracks the American stock market. You need an international one that does the global markets. And believe it or not, yes, a bond market index fund. The reason for this is bonds, although they don't necessarily give a great rate of return in and of themselves. If you go buy a U.S. Treasury bill or a Canadian government savings bond or a British government savings bond, usually the rate of return, especially lately, is very low. However, they provide safety. Bonds usually don't react to the volatility of the market. So if we have a market day where, for example, the stocks, if we have a situation like 2008 again, where the stocks basically crash, the bonds will help buoy up or secure your portfolio. And yes, you might still lose money, but you won't lose anywhere near as much as investors that are only invested in the stock market. And this is what happens to a lot of people that invest with financial advisors, is that they don't achieve this kind of diversification. This is the kind of diversification that you need in order to really be safe. These index funds, because they're buying essentially all stocks, they're much safer against the volatility of the markets. Whereas if you're into a managed fund where somebody's picking and choosing which stocks they're going to buy, well, that's less safe, because if one of those stocks or if two or three of those stocks don't perform very well, you lose out. You lose out on a lot of money. And this is what happened to me. I invested in managed funds. It was called an offshore pension. It was sold to me as being tax-free, right? The two magic words that financial advisors use to hook expat teachers and sucker them in. And when 2008 happened, my account lost 50% of its value. And the reason was very simple: lack of diversification. Lack of diversification, and the fact that my financial advisor had sold me funds that were managed funds that did great for him in terms of the commissions that he earned, but didn't do very well for me. Okay, so anyway, that's just a basic tip where we say, look, if you do this, you'll achieve a significant amount of diversification, and that will give safety. That really is one of the things we want to harp on and hammer on, is that diversification equals safety mantra. It's true. The more spread out your money is, the more likely you are to be able to weather bad times, and you'll also do well during good times. So let's move on to our third sort of main question and get into the nitty-gritty here. Why are index funds better than managed funds in our opinion? Well, the first thing to say is that index funds are actually recommended by many experts, and you can see some of the names there. Some of those names you probably aren't aware of, some of them you are. The first one is Warren Buffett, the great oracle of Omaha, who's himself a self-made billionaire. He actually recommends that people adopt a buy and hold strategy and that they invest in index funds. And the reason is simple. He says, you will never be able to guess what the market is going to do. He said, people that sell you securities telling you that they know which funds are going to do well in the next 10 years, he said, it's all pie in the sky. They don't know. Nobody really knows. He's been able to guess very well for himself, but he has teams of researchers and teams and reams of data that the average investor just doesn't have available to them. Those other names on that list, Samuelson, I admit I included that one because my grandmother's maiden name is Samuelson, so I liked it, and Kahneman, Miller, and Merton are all Nobel Prize winning economists, and they all recommend index funds. Okay, expert recommendation in and of itself isn't a reason to buy index funds over managed funds, but at the same time, it is a strong argument that perhaps when we say index funds are better than managed funds, what we're saying is true. The real reason, to me, is that third bullet point. Managed funds contain hidden fees. And when I mean hidden. Your financial advisor doesn't talk about them, they don't discuss them with you, they don't lay them on the table, so to speak, and you never see them. All you see is that it's cost you X number of dollars or euros or pounds to buy the units in the mutual fund, and they really are units and not shares. People think of them like shares because they kind of function the same way as shares in a stock, but they're not. They're actually units, and this is why outside of North America, you might be confused up till now if you're not from North America, thinking, what the devil is a mutual fund anyway? I've never heard of it. I've never heard my financial advisor talk about it. That's because outside of North America, they're known as unit trusts. We've used the word mutual funds because I'm personally from North America, so it's the word that I'm used to. But I think actually that term lends itself better to understanding what the animal itself actually is. And so in the UK, for example, you call them unit trusts, and that's a little bit better name, I guess, from the point of view of understanding how you buy into them, because you do in fact buy units. Many of you, if you do own managed funds, if you pull out your statement, you'll notice that the number of, quote, shares that you own is actually not a round number. It's not like 50 or 60 or 20 or whatever. It'll be like 17.8832. It'll be some weird number, and you think, well, how can I own 0.8 of a share? That makes no sense. Well, it's essentially because a lot of you are probably doing what I did with my mutual funds, where you just kick in a standard amount every month, and that just buys however many units it can buy. And in a mutual fund, yes, because it's pooling of money, that means you can buy less than one unit with your monthly contributions. But let's move on and talk about these hidden fees, because these are the things that I think are most eye-opening. This certainly is, when I read Andrew Hallam's book, this is the thing that made my eyes bulge out, is all of these hidden fees. So the first thing to say about hidden fees in mutual funds, we want to qualify, as we do with everything. We often give examples and data and statistics here, but we need to qualify things, because the thing about data and statistics is that even though the relationships might be true, the actual numbers, we need to be able to put them into context, because not all numbers are necessarily applicable to all situations. I think one of the things we said in our last video talking about term versus whole life insurance is that the numbers I mentioned in that video were based on whole life policies sold by a major insurance provider in Canada, because my brother works for one, and therefore these were the numbers that I had access to. And I can't guarantee that the numbers themselves are exactly the same, that you can go out and buy a policy that's worth this much for this much. So having said that, our baseline today is a $30 billion mutual fund or unit trust. And in looking around, we discovered that part of the reason that Andrew Hallam used this number in his book is that this is about what a major mutual fund handles in terms of how much money they get in that pool that the fund manager will then invest. It's about $30 billion US. And one of the things you'll be told by the financial advisor, if you're sharp enough to say, how much of the profits of the mutual fund year to year are eaten up in fees? And he'll say, oh, it's only 1.5%, only. And then you realize something, that 1.5% of 30 billion is $450 million. Now that sounds like a huge amount. But when you put it into the percentage, it doesn't sound like very much. But see, here's one of the kickers. The 450 million, these fees are incurred every year regardless of whether the fund makes money or not. And what that means is two things. That A, in a year when the fund does well, this 1.5% basically gets knocked off of whatever profit you've made. So if the fund made a 6% profit, you've only made a 4.5% profit. If the fund has only made a 4% profit, well, anyway, you can do the math, right? The other thing that's true to say is that in years where the fund takes a loss, again, you incur the 1.5%, and so this makes your loss even deeper. And the last thing to say is that this 1.5% does not include sales commissions, or loads as they're called. Okay, so in fact, the fees associated with managed mutual funds can be even more. So let's talk exactly about what some of these fees are. And there's essentially 5 ways that mutual funds, managed mutual funds, not index funds, that managed mutual funds will take your money. And we'll talk in a minute about why index funds are way lower costing. Sorry, that's probably not a very good English phrase, but and why they don't incur anywhere near as many fees. For example, just really quickly, most index funds, the commissions and fees are not 1.5%. They're usually somewhere between 0.25 to 0.5%. So they're a whole percentage point lower. Now, again, 1% doesn't sound like a lot, but hopefully we'll show you with these figures that, in fact, one of the things that we conclude in this video today, which is that small percentages do matter. It does, in fact, matter, because you have to understand that 1.5% is every single year. So if you hold that mutual fund or unit trust for 10 years, you've given up 10 years times 1.5. That's a significant amount of cash. It can be hundreds of thousands of dollars, euros, pounds over 20 years. That should be in your pocket, and it isn't. Okay, so back to our 5 hidden fees here. First fee, the expense ratios. That's the fancy way of saying the fund manager's salaries. The fund manager, the person who's doing the buying and selling for the unit trust or the mutual fund, they don't work for free. And in fact, they often work for very high salaries because what's demanded of them and what's expected of them is very, very high. And usually those fees can be 1.5% right off the top. You know, that's where your 1.5% comes in, that your financial advisor may very well talk about it. He'll say, yes, the fund manager, you know, they scrape a little bit off because the fund manager needs to be compensated for doing all that buying and selling and having his multiple computer screens open and having it all geared towards, you know, sell if this stock hits that price and buy if this stock hits that price, et cetera, et cetera. And so you're paying for this person's expertise is what the marketing tool is that is sold to you. And you'll be told that this person's much better than an index fund, right? That this person will be able to find the funds that will beat the market. They'll do better than the average. Whereas if you have an index fund, you'll only get average returns. This is the way that your financial advisor will say this to you to try to convince you to buy managed funds where they earn more commissions, of course. So the second fee is these 12B1 fees, and these are the marketing expenses. These are the fees that the fund will incur in order to market itself, in order to get more investors to pump their money into the market. I know this sounds a little bit kind of like a pyramid scheme, and I guess it sort of is a little bit. Whereas one of the ways the fund makes more money is by encouraging more people to put their money into the fund. In other words, by making that pot of money grow even bigger, simply from the number of people contributing to it. And these 12B1 fees tend to be, again, if we go back to our example of 30 billion, it would be about $75 million a year. It's about 0.25%. Then the next fee are the trading costs. Every time, even yourself, if you have a brokerage account, I have a brokerage account, and every time I buy and or sell a stock, I have to pay, regardless of whether I've sold that stock at a loss or a gain. Right? The brokerage house, in the case of me, I use a brokerage house called Cordell Consors, which is BNP Paribas here in Germany. I used to use Ingdiba, but I found their fees a little too high. A lot of these online brokerages, the trading fees are very, very low. I think mine, I only pay something like €5 plus a couple of other fees. It ends up being usually about €8 or €9 per trade, which is really, you know, very negligible. But I still have to pay it, and I have to pay it on every single trade. And I have to take that into account, of course, when I buy or sell, right? And those costs are incurred no matter what. Well, it's the same for a mutual fund manager. If he or she is buying, these massive amounts of stocks and bonds and other things, every time they buy or sell, they have to pay for it. They have to pay the middleman, as it were. And that can end up being about $60 million a year on a $30 billion fund. And the key is, one of the big advantages of index funds is that instead of buying 1 million shares of like 5 different stocks, they'll go out and buy 1,000 shares of all of the stocks. And they just hold them. And therefore, that number 3 on the list, an index fund really doesn't incur because there's very little trading. And so they can save themselves, maybe not the whole 60 million, but a lot of it, simply by not trading. And mutual funds often that don't perform quite as well as their competitors, it will be because these trading costs have been higher because the manager has been buying and selling more often. They've been more active. And often some of these mutual funds, they'll even actually chart this and rate this, and it's called turnover. And basically what it means is, if you look at all of the funds and securities, the stocks and securities that the fund held on January 1st, what do they still hold by December 31st? And did they never sell it, or did they sell it and buy it back? And how much turnover has there been? And in the case of some mutual funds, it can be 100%. By the end of the year, they own nothing that they owned at the beginning of the year, whereas an index fund just owns everything and just keeps moving along. And then the other thing, of course, is sales commissions, and these can be high. It depends. But often you don't see them. Often you're not sent a separate bill by your financial advisor. In fact, one of the things we've learned at the Expat Teacher Network is if you are charged separately a flat fee by your financial advisor, this is probably a much more objective and professional financial advisor. My financial advisor never charged me any money separately, and he didn't need to because he was earning himself big fat commissions from the products he was selling me. Unfortunately, these products weren't very good for me, but they were great for him. Okay, and the last thing, of course, is taxes. And number 5 is related to number 3. All of that trading we're doing back and forth during the year, well, we assume that at least a lot of the time that fund manager is selling things at a profit. Well, if he does, he incurs taxes. Even if your mutual fund is part of your IRA account or your RRSP account or any other sort of tax-free account, those are the two in Canada and the US that I know the names of, it doesn't matter because for the fund manager, he's still operating in a taxable environment. And so every time he sells something for a profit, he has to pay capital gains tax because he or she has made a capital gain. So more trading means more capital gains tax. This is one of the reasons we didn't put a number there because it's just impossible to. Each fund is different because it depends on how much turnover. But more turnover means more capital gains taxes, and those capital gains taxes have to be deducted from the profits that are then shared out with the owners of the units of the mutual fund. Whereas with an index fund, because there's very little, if any, trading done, it incurs in a given year virtually no capital gains taxes. And this is one of the ways that the index funds can have fees that are much, much lower. They still have a fund manager. They still have somebody watching. But because there's way less of number 3 and number 5 going on, and therefore number 4 going on, the fees are much, much, much lower. Okay, the other thing that we need to talk about is this concept, again, that we took from Andrew Hallam's book, the concept of survivorship bias. So let's start with a hypothetical. Which team or teams will win the World Cup, or if you're a baseball fan like myself, the World Series in the next 10 years? Because when you're sold managed mutual funds by your financial advisor and they say, based on past performance, we can put you into funds that will beat the market, what they're essentially saying is, I know who's won the World Series for the last 10 years, and therefore I can predict who will win for the next 10 or the next 20. See, hopefully you can see just by the sentence alone how ridiculous it sounds, right? Mutual funds are almost always sold based on past performance. The problem is that mutual funds over a 5-year period and over a 10-year period, and financial advisors will say this, oh, look at this fund, it beat the market. And you'll even find people who will say, no, my funds over the last 10 years have done way better than the market has done. And they're right, they're not lying. But will they do so for the next 10 years? Well, statistically, the answer is no, they won't. And we have a couple of examples here. One is the 44 Wall Street Fund. It was one of the top ranked funds in the 1970s. It beat the S&P 500 average 11 years in a row. That's an astounding record. And in the 10 years after that, it lost 73% of its value. And then it basically collapsed to the point where it had to merge with another mutual fund in order to survive. And then it had to, and that was in 1991, I believe. And then in 1996, that fund merged with another one. And to the point where the Wall Street Fund, the 44 Wall Street Fund, basically just doesn't even exist anymore. All right. And this is what happens over and over again, that yes, a managed mutual fund can do incredibly well for 5 years, 10 years, but over a longer period of time, 20 years, 25 years, they just don't. They never beat the market. And so I know what people will say is like, well, get out after 10 years. It's like, well, okay, yeah, you could, but then you'd have to know when that 10 years is up, essentially. You'd have to know what's coming. And I don't know about you, but I don't have that kind of crystal ball magic knowledge. Number one. Number two, when people badmouth or talk down about this longer term strategy, my answer is always the following. If you're starting in your 30s, or even if you're in your 40s like myself, and retirement isn't until your mid 60s or hopefully even a bit earlier, the truth is investing is a long-term proposition. Nobody expects to invest for 2 years or 3 years, make a whack of money, and get out of the market. I mean, people that are looking to do stuff like that, I guess, buy lottery tickets and then are upset when they don't win. But the fact of the matter is, investing is a longer-term proposition, just inherently, it just is. And therefore, what a fund will do over a 20-year period is a relevant question. If I'm going to buy something and own it and hold it for 20 years, the fact that it does really well for 10 and then does really poorly for the other 10, that's not the product I want. I want the product that's going to grow steadily over time. Each year it's going to do well. Well, we have another example here, the Lindner Large Cap Fund, which returned only 4.1% from 1984 to 2002, right? If you go back and look at their rates of return over that time period and average it out, they average out to 4.1%. Index funds, 12.6. Now, why is it these funds that do really, really well over 5 or 10 years suddenly take a huge dip? Well, if you're a mathematician, you call it returning to the mean. Mean meaning average. In other words, that these funds, while they might outperform the market average over a period of time, they'll eventually come back to earth. You know, the rocket ship takes off, but eventually it burns out of fuel and it has to come back to earth. It's essentially the same concept. So you have to be really aware of fund managers that are selling you these funds and things based on past performance. Past performance, they'll even say it in their disclaimers, past performance is not an indicator of future performance. It's like, well, if it's not, then don't talk to me about it. Put me into index funds where the fund is going to do exactly what the market does, and then if the market, does well, I do well. If the market doesn't do as well, I don't do as well, and so be it. Okay, let's move on again. We want to talk about some other things that are sort of red herrings that financial advisors will throw at you and use to get you to buy managed funds as opposed to index funds. And one of these things are ratings. One of the most famous ones, remember my financial advisor saying this when I was saying to him I didn't like the funds I was in, I wanted to switch, and he just said, oh, go on to Morningstar.com. It's a great ratings agency, and see which funds are rated at 5 stars, right? 5 stars is the best and 1 is the worst. And, pick the ones you like. And the truth is that 98% of invested money that goes into mutual funds goes into funds that are 5-star rated by Morningstar. Morningstar is considered the main rating agency for mutual funds. But then if we go back and look at it, if we go back and track past data, and I know we just said past performance is no indicator, but in terms of comparing these things, all we can do is do past data because we don't have future data yet. So if we go back and look at 5-star funds, funds that had a 5-star rating from Morningstar versus total stock market index funds, and we look at it from 1994 until 2004, a 10-year period, because often these fund managers and financial advisors will say, oh, we can beat the markets. And for a period of 10 years, often many of them do. But if you look at $100 that was invested in 1994 with a 5-star, any 5-star rated fund from Morningstar that year, and then look at it 10 years later, you can see the figures that before tax, the 5-star funds returned only 6.9% in 10 years. So the person with $100 had $194. The index fund returned 11%. So that person that had $100 originally ends up with $283. Remember, this is compounding, right? This is why the numbers are so much higher. That gets back to our second video, the magic of compound interest, right? And eventually that the interest keeps rolling, and it's interest upon interest earned, and you get a snowball effect, like a snowball rolling down a hill. And after tax, you can see that the 5-star fund only $165 or 5.15%, whereas the index fund person had 271 or 10.5%. It's very clear which type of fund is better for the individual private investor. It's not even a contest, really. There's really nothing else to say other than watch out. These mutual fund managers and these financial advisors, they love their managed funds, and they have all kinds of seemingly convincing arguments for why they're better than index funds, but the data doesn't bear that out. And the experts would agree with the data. They say, no, there's just no way over a longer term, 15, 20, 25 years, that any fund manager and any managed fund is going to beat the market for that many years in a row. So let's talk about who actually, where can you go to get these index funds? You can get them at a lot of places. Probably for the most international and the best ones in terms of fees and whatnot is this company Vanguard. Just at Vanguard.com. It's a nonprofit investment agency. You can sign up with them. They're not in every single country in the world, but they are in most of the countries, I think, that tend to supply the world with its expatriate teachers. They're in the United States. I believe they are now in Canada. I'm not sure about that, but they're certainly planning to be. They're in Australia. They're in the UK. They're in other places. Another one is RW Investment Strategies. And then iShares by BlackRock. iShares is definitely all over the world. That much I can promise you. I've been on their website, and they have a little thing where you can click, and that's the link there. iShares.com/global/index.jsp. There, you just put in your country, and it'll direct you appropriately. Although, be warned, if you put in your country, the BlackRock or the iShares site will switch to that language, right? Like if I put in German, it switches to German. So you have to be able to read the language of the country you're living in. The Apero Group and Evanson Asset Management. Some of those groups are, I believe RW Investments is located in Virginia, and I believe the last two are located in California. So they're all American-based, and I admit I'm not certain whether you have to be American to join them or whether you can be something else. But certainly get on those websites, have a look around, contact them. They're more than happy to answer questions, I'm sure, from people that are going to give them money. So it's quite an easy question to say, I'm so-and-so and I'm an expatriate living in country X, but I'm really from country Y. Could I have an account with your company? The other thing you can do is do what I do. I just have a regular brokerage account, and you have to go searching for the index funds yourself. So, for example, you don't need a Vanguard account to buy Vanguard index funds. They're available on other exchanges as well, sometimes as ETFs. And if you're not an exchange traded fund, if you're not sure what that is, it's basically like buying a mutual fund through a stock market. That sounds a little bit complicated. It's really not that complicated though. But anyway, that's how I got into Vanguard funds, is through ETFs. Okay, so that's it for today, and that's it for our two main messages. Small percentages pack a big punch. Hopefully we've been able to show you how small percentages can add up and really eat into your profits, and therefore why you need to look for funds, i.e. index funds, that give you A, more diversity, and B, lower fees, that therefore C, protect your profits and allow you to reap as much of the reward for your investments and your money as humanly possible. And the second message, hopefully we've shown you that not all mutual funds are the same. Don't forget basic diversification, country stock market index fund, international fund, and then some bonds. Okay, we're going to go in subsequent videos into a lot more detail about, if you live in this particular part of the world, what's a reasonable portfolio, simple to start with. The nice thing about a lot of these portfolios is they're just sort of buy and hold. You don't really have to pay much attention to them. So if you're the sort of person that hates doing this kind of stuff, this is tailor-made for you. In subsequent videos here at Expat Teacher Network, we're going to talk about what if you really do like to invest, and what if you do like to watch it every day. What are some things you can do with very, very small amounts of your portfolio to play a bit, so that if you lose a little bit, it's no big deal, and you still sort of satisfy that hobby you have without damaging your main account that's growing your wealth for your retirement. So there's the sources that we used for today. As we said, Andrew Helm's Millionaire Teacher and the Global Expatriate's Guide to Investing. They're both available on Amazon. You can get to them right from our website, expatteachernetwork.com. A couple of the other sources we used. We'd like to thank everybody for listening today and to remind people to come and join us at the Expat Teacher Network at our website or on our Facebook page. It's just Expat Teacher Network. Send us a membership request. We'll approve you, we promise. No background checks. And hopefully the information today you've seen is useful. And we'll look for you next time. And thanks for listening.